Hi, my name is Vanden Brul, and I'm a fixed income portfolio manager at Howe and Rusling. As market volatility and inflation concerns persist, many investors wonder whether adding alternative assets like cryptocurrency or gold is necessary to protect their portfolios. For those that are not familiar with alternatives or alts, alternative investments are non-traditional assets that typically fall outside of stocks and bonds. Common examples of alternatives include gold, real estate, private equity, private credit, hedge funds, and cryptocurrency. Let's quickly go over each alternative asset. Gold, which is a tangible asset often seen as a hedge against inflation and geopolitical risks. Real estate, which offers income and potential appreciation with relatively low correlation to traditional equities. Private equity, which provides opportunity of ownership in private companies, often with the potential for high returns, but low liquidity. Private credit, which offers investors a way to generate income and potentially higher yields through debt investments, but low liquidity. Hedge funds, which are pooled investment vehicles using complex strategies to seek uncorrelated or absolute returns. And cryptocurrencies, which are digital assets like Bitcoin and Ethereum that operate independently of traditional financial systems. Now that we've covered the different kinds of alternative investments, let's take a look at the pros and the cons. Some pros of investing in alternative assets include diversification by reducing reliance on traditional market cycles, inflation protection as gold, real estate, and commodities may outperform during inflationary periods, return potential as certain alternatives like private equity and crypto may offer upside, and low correlation with traditional assets, which may help limit volatility across a portfolio. Some cons of investing in alternative assets include liquidity risk, as many alts like private equity or credit and real estate are illiquid, volatility in alts like crypto, complexity and transparency as alts often involve higher fees, less regulation, and limited reporting, and tax complexity as alts may require specialized tax treatment. Turning to cryptocurrency or crypto is one of the most debated alternative assets at the moment. Many people consider whether it's an investment that can work as a hedge across a portfolio. Whether crypto fits into a portfolio as a hedge depends on how you define hedge and what kind of risk you're trying to offset. There are a number of potential pros and cons of including cryptocurrencies in a portfolio as a hedge. Potential hedge opportunities include inflation protection, as some view Bitcoin as a digital gold as is a limited supply asset that can preserve value over time in an inflationary environment. Currency diversification, as crypto is not tied to any government, which can be appealing in times of fiat currency instability. And decentralization, as crypto operates outside of traditional banking systems, which can be a form of systemic risk hedging. On the flip side, there are also a number of potential cons of including crypto in a portfolio as a hedge. Potential limitations and risks include high volatility, as crypto assets can swing wildly and in some cases more than stocks or even commodities. Correlation to risk assets, as at times, crypto follows trends of tech stocks rather than acting as a hedge. Regulatory uncertainty, as ongoing changes in global regulation can introduce risks. And lack of cash flow, as crypto does not generate income and its return depends entirely on price appreciation. So how should you think about crypto in a diversified portfolio? Given crypto's volatility and speculative nature, incorporating the currency in your portfolio is dependent on your risk tolerance. For those comfortable with the risk, a small allocation to cryptocurrencies of 1 to 6% of total portfolio value is recommended according to investment firms VanEck and BlackRock. Rather than viewing crypto strictly as a hedge, consider crypto as an asymmetric bet. High risk, potentially high reward. Institutional grade custody is critical. Platforms like Coinbase Institutional, Fidelity Digital Assets, and qualified custodians offer better protection than retail wallets. Lastly, crypto is not taxed as a currency, triggering capital gains taxes upon sale, trade, or even spending. The use of alternatives as a hedge in a portfolio is dependent on the individual's risk tolerance. But for those who understand the risks and want to diversify beyond stocks and bonds, a carefully considered allocation to alternatives may offer value. Thank you for tuning in to today's Street Smarts. See you next time.